Thanks very much, Steve, and greetings to all of you and the familiar faces. I was on the program to talk about energy finance and models. And although I have been involved in the modeling work, which I'll briefly mention, I'm mainly going to be talking about finance. And I'm glad that my colleague from Stellenbosch ended off with storytelling, because I think my entire career has been devoted to changing the stories we tell ourselves. And my latest story that I'm trying to reconstitute is the story we tell ourselves about money. Because the stories we tell ourselves about money, in my view, and after a lot of reflection, is a fundamental obstacle to how we think about change and transition. If we remain thinking about money in the old paradigm, we actually will not be able to identify the sources of capital required to finance the transition. So there are 3 pieces of work that I've just brought to conclusion. One is a 256-page report for the National Planning Commission called The Transformation of South Africa's Monetary Architecture, 1983 to 2024. The second is a collaboration between the DBSA, the National Treasury, the PCC, and the CST and the NPC, which was a precursor to the third project, which is to identify what the South African Reserve Bank calls the whom-to-whom flows of capital. And this has been now done for the period 2010 to 2021. In other words, who gives money to whom and who receives money from whom. Unless we understand that from a systems perspective, we are not changing the story. And then thirdly, to develop a new non-equilibrium stock flow consistent model for understanding the macroeconomic, or specifically I should say the macro-financial implications of the energy transition. And it has been necessary to develop a new modeling framework because the dominant modeling methodologies in South Africa are CGE models, computerized general equilibrium models, which assume equilibrium. And they can assume equilibrium or a tendency towards equilibrium because they exclude finance and they exclude climate damage factors. If you want to realistically assess the macroeconomic implications of energy transition, you have to endogenize finance and a climate damage factor. We've only, over 3 years, done the first one. The next 3 years will be the second one. And we're starting work based on the success of the first report, a 3-year project to develop the monetary architecture of Senegal, which is one of the fastest growing economies in the world of oil and gas. And they're asking questions about what happens over the longer run. So in a nutshell, so if you get nothing about what happens after this slide, then that's fine, as long as you understand this one, which is South Africa has to finance its infrastructures on a large scale like all African countries. However, this is in the context of constrained fiscal space, monetary policy conservatism, declining FDI, declining ODA, and so therefore the question is, where's the money going to come from? And this goes back to the story we have to change, which is in a credit-based system, in other words, post-71, when we dropped the gold standard, the architecture of a financial ecosystem should be understood as a web of interlocking balance sheets. There is actually no value underneath the money you have in your account. There is no underlying material value. The gold is gone. The value of the dollar, the value of the rand that we ascribe to that piece of paper or that signal in a bank account is purely based on what we agree the value is. Everyone's liability is somebody else's asset. Everyone's asset is someone liability. There's no underlying value in a credit-based system. That means we have to change our understanding of money. It must be understood as part of a complex adaptive system. And capital flows, therefore, it follows, are a function of the way in which the balance sheets of a given country interlock with each other and with international balance sheets. And so if you want to change the flow of capital or create new capital, you have to change the ways in which these balance sheets interlock with one another. In short, we need a better understanding of money. We need specifically, technically, a better understanding of what financial systems are. The overall conclusion of this presentation is that the conclusion of this report that we did for the MPC, which landed up on the front page of Business Day as a kind of revelation, is that we have plenty of money. We have plenty of money to meet our infrastructure requirements, yet government's narrative is we don't. There must be a problem here, and it can only be a problem of the story we tell ourselves. So the reason for doing this work is that the collaboration between the National Planning Commission, the National Treasury, the PCC, and the DBSA led to a couple of very significant reports on the investment requirements to achieve our infrastructure goals, which I don't have time to go into this, which essentially boils down, when we did the analysis of water, energy, and food, we also did digital infrastructure. The total requirement is roughly 400 billion per annum, but the gap is about 90 billion per annum up until 2030. Up until 2030, there's more than enough money, in particular for the energy transition, but not enough for the water and food that needs to be generated. And you're only going to face constraints after 2030 because there's uncertainty about what happens after 2030. So the traditional way of understanding the flow of capital in a national economy, inherited from 150 years of economics, is that you have a state, it collects taxes, it accesses loans, it issues bonds, it funds infrastructure. That infrastructure catalyzes growth. If you have economic growth, you can collect the taxes, you can access loans, and you can issue bonds that people buy. But if your state is broken, and ours for a very long time in recent years has been fundamentally broken, what happens to this flow? What happens to this capital flow? How can we rethink it? So Bernard showed the picture of what happened to rooftop solar because the grid broke. The same thing's happening in the financial system, which I'll get to. So to be more specific and more correct, what is the monetary architecture approach, which has only been applied once in the Eurozone? We're the first global South country that have applied this framework, which has its origin in what is called critical macrofinance as a school of scholarship, is what I've already said. It sees financial systems as a web of interlocking balance sheets. Financial flows are therefore a function of the way in which balance sheets are configured. What we need to identify from a policy point of view is what we call elasticity spaces, where there is potential for reconfiguring these balance sheets, but we need to do this in a way which contradicts some pretty powerful economic theory. Keynesian economic theory, which says tax, spend, borrow, and modern monetary theory, which is print more money. We disagree with both of those, and say we actually need to unlock capital when we understand financial systems as an integrated ecosystem. We looked at every single set of financial institutions in South Africa using this basic template, the actual assets and liabilities and the contingent assets and liabilities, and we addressed three challenges. Why is South Africa so unequal? And that has hardly changed since '94. Why is there a decline in investment in gross fixed capital formation, given that without a rise in investment in gross fixed capital formation, you can't have economic growth? And why don't we have a system of macro-financial governance? So these are the balance sheets that we analyzed. I don't have time to go through them. You can't add up these particular numbers because there's overlaps between them, but we analyzed all of them. But in the whom-to-whom paper that I referred to, which is based on SARB data, South African Reserve Bank data, for the period 2010 to 2021, the total assets in South Africa is 49 trillion. So Steve, if you want to buy South Africa, write a check for 49 trillion.
I'll speak to the donors.
Okay. The whom-to-whom paper makes it possible to understand the flows of capital. In other words, from whom to whom is capital flowing if you cluster the different sectors together. There's government, the SARB, the banks, the non-banking financial institutions, households, and the non-financial corporations, NFCs, and then the rest of the world. And you can see there's a growing line into the rest of the world, which is a reflection of the way in which more capital is flowing out of South Africa than coming into South Africa. And you can see the big line between households and non-banking financial institutions, which goes back to this number here. Under households, you can see it's 11 trillion out of the 49. So household balance sheets in South Africa are really significant, and I'll come to where that money is. On gross fixed capital formation, this is what it looks like. This is DBSA figure based on SARB data. You can see more or less from about 2010, 2012, we see a really rapid drop in investments in fixed capital over the period since 94. This is the sectoral breakdown. And the diagram on the right is important, which is the distinction between infrastructure and gross fixed capital formation in general. And energy is a big part of that. And you can see that the pattern is similar. And obviously, investment in fixed capital formation is heavily driven by investments in infrastructure and energy in particular. But if you compare us to other parts of the world, we really are at the bottom. This is comparing us to the upper middle income countries for the period 2013 to 2022, and then a projection forward. Really doesn't look pretty. There's a number of African countries that might be sitting here that are above us in terms of levels of investment in gross fixed capital formation. As a rule of thumb, if you want to grow economically to meet the requirements of your population, you should be investing 20 to 30% as a percentage of GDP in gross fixed capital formation. The National Development Plan, and I'm on the Commission, targeted in 2012 a 30% target for an investment in gross fixed capital formation. We're averaging at around 10%. So if you look at household wealth, I said I'd come to this. Household wealth is extremely, extremely unequal in South Africa. We can now analyze household wealth from the perspective of balance sheets, household balance sheets, as a result of recent work by academics at UCT and Stellenbosch. And essentially, to cut a long story short, because I don't have much time, 0.1% of the population, which is about 35,000 individuals, their wealth is equal to twice the wealth of the bottom 90%. This is one of the most extreme forms of asset wealth. I'm not talking about Gini coefficient, not talking about income inequalities, asset inequalities. And these asset inequalities have got a lot to do with the way in which the financial system is configured and where household wealth goes and where the managers of that wealth put that money, which I will come to. But just to stick for a moment with fiscal policy. In terms of fiscal policy, the news is quite good. 10% of the population pays 72% of the taxes, and 60% of that benefits the poor. So we have a redistributive system when it comes to fiscal policy. And this has had positive impacts on small numbers of poor people and had quite a big impact on the middle class. We have a deracialized middle class to some extent, but the elite remains largely white and have most of the population, of the wealth. In terms of fiscal policy over the years, We've seen this decline in core spending, what Michael Sachs, who used to head up the budget office, calls core spending. That corresponds with the decline in investing in gross fixed capital formation over the years. But it's a mistake to only focus on government, which is a mistake that we've often made in South Africa. If you look at the work of Nimrod Zalk, who used to be, I think, a deputy DG in the Department of Trade and Industry, if he wasn't a deputy, some very high up, this is his work on the private sector, which shows that between 1994 and 2014, the average growth in investments in gross fixed capital formation remained very low. The highest is telecommunications. The lowest is agriculture. And you can see all the numbers in between. Many of them are below 10% even. And it should be 20 to 30% on average overall. And then you might say, well, it's because these companies don't make profits. Well, that's also not true. The net markup is actually very high. And I've defined net markup on the right-hand side. So if you look at agriculture, very high net markups, very low reinvestment in expansion. If you look at communication at the top, very high net markups, but actually quite the highest level of reinvestment. That's your MTNs and Vodacom's infrastructures over these years. Now, to summarize this, if you take all the economic sectors and you remove the orange and blue, which is essentially finance, take finance out and just focus on non-financial sectors, you will see that they're reinvesting in fixed assets by 150 to 200 billion per annum, which is equal to roughly 10%. That should be 20 to 30%, according to the National Development Plan. It's not. This 10% is actually only equivalent to replacement. It's not really equivalent to expansion. So, and yet, these are very profitable companies. And don't forget that JSE is one of the most profitable stock exchanges in the world, second only to Hong Kong for most of the last 30 years. And our banks are some of the most profitable banking sector in the world. So there's a lot of cash going around, but it's not getting reinvested in fixed assets. And that's really the core of the South African problem. And this hasn't been adequately understood because we don't understand money. The biggest losers are the small and medium enterprises. They create more jobs, they create more value, but they can't access capital to expand. They create more jobs than the big corporates, they create more value than the big corporates, and they can't access capital. Why? Because in particular, the banking institutions are geared to the bigger corporations and listed companies, and they don't even have the capacity to figure out how to do the right kind of lending to the smaller scale. The rise of Capitec has got a lot to do with developing, of exploiting that gap. Sorry, I thought these numbers were there. These are the numbers for the different sectors and the value add. As far as large listed companies are concerned, there's a big concern in the people who watch the stuff with the levels of concentration. In 2017, the top 100 was 95%. Top 100 listed companies, 90%, 95% of the JSE. The top 50, 86%. The top 20, 71%. And the top 35% is alcohol and tobacco in the South African JSE. It hadn't changed that much by 2024, but the significant trends are large listed non-financial corporations are actually externalizing a lot of their financial assets, roughly 3 trillion over the 2010 to 2021 period. The increasing number of firms who actually have no operations. So they source capital here and they invest elsewhere. And if you remove the dual-listed companies from the top 50, the remainder only counts for 20% of the JSE in 2017. So, you know, this is just a story of externalization. And it's coupled to the fact that we have high profits, low investment, which means the financial sector actually expands faster than the real economy, and that money has to go somewhere. And if you're not investing in stuff, you put it in the JSE, which is why our JSE expands like it does. To break down the financial sector into its different components, this is the work of a Stellenbosch Business School PhD. Banking is roughly equal to GDP. If you add the non-banking financial sector together, it's bigger than GDP, which is your insurance industry and your pension industry. And then ASISA, the Association of Savings and Investment in South Africa, is the club of those two segments. And then you have the shadow banking sector, which has expanded rapidly, and I'll come back to that. Why? Because if more and more money is spinning around the South African economy and not going into fixed investments, where does it go? It keeps on spinning, and it has to keep on spinning faster and faster, and who does that? It's the shadow banks. So if you go to Camps Bay, you'll see people in copy shops at their laptops moving money around in order to generate the fees they need to pay for the Ferrari standing outside. So this is where household wealth has gone, into pension funds. Since 1994, there's been a rapid growth in the size of South Africa's pension funds, and the government employees' pension fund is the biggest. And essentially, this shift of savings out of banks into pension funds has major implications for how we understand investment in the South African context. Because you have to ask, where does this money go? So according to ASISA itself, this is where the money comes from, and this is where it goes. It goes to banks, it goes to government bonds, a little bit goes to fixed interest, and then an increasing amount into equities, and more, which is not reflected here, into external investments. So to manage these financial flows, you have this incredibly complex network of what are called shadow banks. The SARB prefers to call them shadow banks. ASISA doesn't like the term. So I've chosen to go with SARB. And there are 4 clusters. There are many different variations on this theme. But in a sense, they're money market funds, fixed income funds, multi-asset funds, and funds of funds. And some of these kind of overlap with institutions. But what is very concerning is that there is a very unhealthy value chain where pension money gets put into insurance funds, which gets put into shadow banks, and along the way, all the fees are getting paid. And it's extremely inefficient. As far as SOEs are concerned, this is from the National Treasury Budget Report into a budget review of 2024, which essentially shows that, yes, our SOEs are 30% of our economy, but they have suffered badly from state capture during the Zuma years, and there hasn't been a significant recovery since, except in recent years with respect to Eskom, and now Transnet is turning around, and things are looking up, but overall, this is the 24 number. We're still underwater. If you look at capital spending, which is obviously critical for gross fixed capital formation, this is from Michael Sachs, who used to head up the budget office. The decline in spending by public corporations since 2014 corresponds directly with the decline in investment in gross fixed capital formation. There's been a bit of a delay in some of the other institutions following suit, but that's because some of them have their own tax bases, like local governments and SETAs. But this is really what needs to change our way of thinking, which is, in theory, when you invest in gross fixed capital formation, but in particular in infrastructure, you do it in order to generate value in subsequent years. So there is a measurement that Michael Sachs uses to assess that, which is called ICOR, the incremental capital output ratio. If that ratio is going up, it means that your bang for your buck is going down. And so in the 70s, when we were investing heavily in the electricity infrastructures that Bernard said he wouldn't have studied in the 1960s, there was a lot of money. Public sector investments was very high public investments, but that money actually had very significant positive economic impacts. Therefore, your ICO was low. Now we have low levels of public investments, low impact because of the weakening, the hollowing out of the state-owned entities, and a high ICO. And that is an important driver of this terrible, I call it the hypotenuse, jaws opening up between, which is going to swallow us, the 10-year bond yield, which it has started to decline, and the nominal GDP growth trend. The wider that gap, the more sure you can be you're heading into a very fundamental debt crisis. And that's where we're heading. Interestingly, partly filled by the banks. So the banks have stopped investing in the private sector, have stopped increasing investments in the privates, leveled out, and increasing significantly their investments in government bonds. And that's unsurprising given that the bond rate has been around 10%. So the banks are smiling, investing in these secure pieces of paper, but the government has to pay that back. And if the economy is not growing, they're not going to be able to. And if the private sector is not getting money from the banks, it's unlikely that the economy is going to grow. There is some good news when it comes to climate finance coming out of the PCC report, which shows that there's a very significant growth in private sector investment in the energy transition. So 188 billion, they calculated for the period 2022 to 23. 50% comes from domestic private sector sources, nearly 100 billion rand, which corresponds with the point I made earlier, there's enough money for energy. But 35% came from international public sector resources. So 85% is a combination of domestic capital and international public. So in summary and near conclusion, no growth is possible with a declining gross fixed capital formation. The drivers of this decline, SOE weaknesses, NFCs not reinvesting, SMEs starved of capital. Yet the financial system grows faster than the real economy. And so where does the cash go? Well, 45% leaves the country, a la Regulation 28, but that is now maxed out. So there's a buildup of capital that can't go anywhere, and there's pressure to find outlets, which is good news. The growth of the shadow banks is to help manage this flow. You need to get these shadow banks to start thinking about the real economy, because they are very skilled, very agile, and they can redirect. The deal flow will be slower, they'll get less fees, maybe the Ferrari has to get sold. And there's plenty of capital to invest in infrastructures. And the obstacle is there isn't an adequate pipeline of projects in order to make use of the buildup of surplus capital. And the challenge that I've made to the financial industry, don't sit back and wait for government to deliver the pipeline. You have to collaborate. And we are working with ASIS. I never thought I'd be working with pension funds to figure out how to invest in public infrastructure. So in short, this is what's emerging. If you go back, if you remember the model. Yes, government is going to still access taxes. Yes, they're going to access loans. Yes, they're going to invest in infrastructures. However, something else is going to start happening. More and more loans and bonds are going to go directly, not via the state, into blended finance vehicles of various kinds. Yes, loans will still be there, but might be diminished. Bonds will still be there, but might be diminished. And you're going to have an alternative set of institutions emerging. One example is the Infrastructure Fund, which I helped set up as in my capacity of chair of the DBSA, which is South Africa's biggest blended finance vehicle. But we've been playing around with various models, which I don't have time to go into, that you can reconfigure in different ways. And we end off with a whole series of recommendations, which are essentially balance sheet reconfigurations to unlock new capital and expand existing flows of capital in a way that starts to generate a story about how we can understand the way in which we could finance our energy transition. So there are 14 recommendations. And I've run out of time. I was going to speak about our non-equilibrium modeling work being done with various partners, which is essentially to, as I've already said, to figure out how all of this work actually gets translated into a non-equilibrium model that allow us to do the things that models do, which is to underpin the stories we tell. Thanks, Bernard.
Thank you, Mark. I think Deborah made the point yesterday that the magnitude of the challenge is pretty huge and that we have to think differently. And what I really like about what Mark's been doing is it's a way of thinking differently. So thanks very much, super interesting. I know quite also gives us a sense as a community of how complex this gets, right? And most of us are starting out on capacity modeling. And then Bernard showed us, well, actually, it's more than that. You've got to get down into these microsecond grid things. But then you layer on the finance, you layer on the climate change. This is a complicated space. And I think makes the point that we cannot do this alone, which is why this community is so important to the PCC and to AEF and to CCG. This is where it's going to happen. Any questions for Mark? We'll take one round of quick questions. Most people are going to be shell-shocked. Go ahead. So at 1, 2, 3.
Thanks for that presentation, Mark. I had a question about this slide where you estimated the investment requirements by sector. I was wondering how you arrived at those numbers and how sensitive they are to different input assumptions, because they're quite specific numbers. So just to know what maybe an uncertainty range is. Yeah.
And then Gillian.
Thanks, Mark. I just want to get an idea how much of this accounts for the informal sector as well and what's happening in that space. And then just any quick reflections on what we do with that inequality gap that stayed so stubborn and how we create assets in a growing middle class. Thanks.
Thanks, Commissioner.
Thank you.
So maybe people should introduce themselves because Mark wasn't here yesterday. Sorry.
So it's going to start with me, the introductions, because everybody just went. Anyway, thank you, Steve. Thank you, Mark. So I'm Andile, Mark. So right now I'm wearing a civil society hat for this question, you know. My question is, I saw the balance sheet that you put on your slide, and I just wanted to find out on, so there's a lot of financing that is being reported, you know, from the multilateral banks, like the FDB, that goes to infrastructure and energy. So I don't know, where is it placed? Where do you find that finance? Because continually you see it being reported and it is placed. And for instance, in the case of Komati, same thing. We had money from the multilateral development banks. So where is it placed in the whole balance sheet? Thank you very much.
Okay, so on your question, and I could see you could understand my language, so I appreciated that. What we did, we instead of doing the traditional costing of infrastructure, we called it the investment requirements over a long period of time. And the investment requirements include both CapEx and OpEx. So, you know, strictly speaking, OpEx is covered, you know, but not really. So that's why we defined it in that way. It was a lot of the water work, the water modeling work was mainly spreadsheet based, based on years and years of data collected by Palmer Development Group that did the work. So that's kind of very real assessments going forward, projected forward based on existing reports. So those are fairly hard numbers. And the gap is huge when it comes to, we have a water crisis. The energy work was based on a multiplicity of different energy models that were interconnected with one another. And it took a lot of the existing agreed numbers, many of which Bernard referred to, and people like Rové Steyn from Meridian and various others, and in the IRP report itself, we took some of those curves, demand curves that come out of UCT. So I think a lot of the assumptions in the energy report are also pretty robust, but they are different to the official energy policy, integrated resource plan. With respect to, they're quite bullish about nuclear. We don't include nuclear for mainly cost reasons. And we are over-optimistic like they are about gas. But we have a lot more backup than the IRP. And we don't understand why there's not enough backup in the IRP if you're making the transition to renewables. Food was based on the work of Julian May at UWC, which is really the lead research center when it comes to food policy. And it was a challenge to shift mindset to infrastructure, canals, irrigation infrastructure, and so on. So I think overall, it's OPEX and CAPEX, and it's fairly robust based on a lot of empirical work projected forward. And then the translation into investment requirements, the financials, was the tricky part. Because you had to make a whole bunch of difficult assumptions about discount rates and so on. But yeah, we're fairly confident about those projections. As far as the informal sector is in that whole section on SMME. So the way the report is structured is we look at 4 snapshots. We look at the 1983, 2016, 2014, 2024, and the state of the balance sheet configurations in those 4 historical periods within the context of the political economy of those periods. Each section, each historical moment has a section on SMMEs and shows how they have grown and makes a distinction between the informal SMMEs, which are 2 or 3 people, 1.7 million people, not a lot of value add, not a lot of assets. And the 700,000 SMMEs that have got a VAT registration, a CIPC registration, et cetera, that employ a lot of people, mobilize a lot of capital, don't get access to capital. The informals are also mainly led by women. The reason why the 700,000 middle-sized SMEs have not gained much attention, in my view, personal view, is that they were traditionally white after 94, but they're now 60-70% black as a result of BE enterprise development and so on and so forth. So as far as the expansion of the middle class is concerned, which is one of the recommendations, there's a number of things that have to happen. In particular, gain access to capital for the informal SMEs and the middle-sized SMMEs. And there is a category above that of still within that sector, non-listed, medium-sized enterprises. There's about 40,000 of them in the country that have the capacity, according to Investec, to take loans of 10 million and above. So all of those, there's no expansion of the middle class without getting capital into those businesses. You're not going to grow the middle class off the expansion of the public service. The corporates don't add as much value as the smaller businesses. There is a whole sliver of listed JSE companies that are smaller that source capital locally and operate locally, but they're in a minority. But I call them the true South African listed companies. And the other true South African listed companies are those middle-sized, that's 700,000. That's where you grow the middle class. But the transformation fund debate is, to put it mildly, a bit insane. You could do something much more intelligent than that. But it's a good idea. And so just to put it in perspective, 8.5 billion for the JET IP, 1.5 trillion rand. Sorry, not the JET IP is 1.5 trillion through to 2030. The 8.5 billion only contributes 10% of that. So when we think of climate change, when we think of energy transition, when we think of funding, in particular energy transition, we focus much too much on the potential of foreign funding doing the trick. And we don't have the discussion about mobilizing domestic capital. Just to give you one very practical example, and taking a bit of a risk. The National Transmission Company is issuing an RFP for companies, private companies, to get involved in building out the transmission grid, right? Who qualifies to bid for 10 billion rands worth of infrastructure projects? No South African company. Only international companies. Where are they going to source their capital? Not from here. Where are they going to get their components in terms of upstream value chain? And not from here. That's the mindset that is problematic when we as South Africans think about how we drive our energy transition. South African companies built the biggest grid on Africa over the last 100 years and are excluded from participating in the biggest infrastructure project since 1994. Something's wrong.
So I'm afraid we've run out of time, and there are still lots of questions, but fortunately Mark will be on a panel a little bit later, so you'll have a second go at asking him lots of complicated questions, but also we can have a sort of PhD in energy modeling, dynamic systems table at lunch, and we can have a finance table at lunch. So thank you very much, Mark.